Welcome back. We have been speaking with Mr. KV Kamath, the veteran banker who has just released the ratios by which banks have to adhere to when they restructure corporate loans. So I wanted to ask you another question, which is kind of the elephant in the room. The court hearing this case on waiving interest on interest. Now, the court has said one thing already, that moratorium cases should not be marked NPA. And the second thing that they are going to decide is that interest on interest may be regarded as penal. They have not yet pronounced on it. Do you think if they did one or both of these things, it might vitiate the atmosphere? I mean, after all, if banks are told that they can't charge interest on interest, what can they do? They have to charge higher interest to the next borrower, to the healthier borrower. Won't it stymie transmission? I mean, what kind of problems do you foresee?
Latha, again, this is a matter which is the Honorable Court is considering. So, to me, clearly it is sub judice. So,
of course,
it would be wrong on my part to comment on that subject.
Okay. No, I'm not asking you to say whether that would be right or wrong, but it could have a fallout. Would you worry about the fallout?
I would rather not comment on that.
Okay.
Honorable Court should give its...
Yes. No, fair enough. I'm not asking you to comment on what the court might say or whether it is right or wrong, but it's just that I'm only scared that it might have an impact on both depositors and borrowers and even the healthier borrowers. Okay, separately, sir, do you think the government needs to pitch in? Because the corporate sector is going through a rather severe stress, do you think an interest subvention from the government, rather than make the depositors bear the can, or the good borrowers bear the can, would it make sense for the government to pitch in with either interest subvention or some payroll tax relief?
I think it's at this stage, again, what steps the government has taken have been far-reaching, the way I look at it. And I'm looking at it dispassionately. I think at this stage, when we looked at it, we did not see the need for a subvention on this front. Again, we will have to see the course of the disease and what happens next. At this point in time, things seem to be going on track to recovery. So I would think that any of these other instruments that we might need to look at probably are not called for at this point in time. We'll have to watch. Again, I want to reiterate that the course of recovery seems to be, as an observer, outside observer, better than what I would have thought just, say, 12 weeks back.
Okay.
And I would think that should provide us enough runway to get this economy back in flight path.
Without the kind of help that I'm suggesting.
Without the kind of help.
Okay. So again, going to go back to your quadrant, when you said 72%, did you include MSMEs when you said corporate sector?
No, this doesn't include MSMEs.
Okay. So now if you take the MSME segment, of course, they are getting a little more time for restructuring, and the restructuring was available even last year. There is also another piece now, retail loans, which the banks, of course, will decide on their own, but that's now a substantial part of bank exposures. And we hear from organizations like the CMIE that about 20 million salaried jobs have been lost in the last 6 months, and this does not even take into account the amount of pay cuts that the existing salaried jobs have suffered. If you take that into consideration, what is your estimate of the kind of pain the banks are suffering? Do you think we are going to look at what, 15-14%, the kind of stress that RBI spoke about?
Again, we have not assessed that, and having not assessed that, there are certain proxies we can look at in this. Indeed, the job losses were one.
Yes.
I would also look at the other number, which is the jobs in the unorganized sector, which CMI itself has said have come back. Now, if both were there, we would have had a serious problem. The fact that those other jobs are coming back, there would have been pain. There probably is continued residual pain. I think is good news. I think on the salaried class, if you look at the fact that corporates are expecting that in the next 1 or 2 quarters, they're back to about 90% of capacity utilization. A lot of these jobs would come back. As also, when we see migrant-heavy activities, construction others coming back, I think these would come back. Now, I'm not very sure whether CMI counted that or not, but I would dare say that once the economy comes back, the pain goes down from 24% drop in GDP to over the next 3 quarters dropping pain. These jobs should be coming back. So as a banker, I would think that indeed there will be pain in the retail sector. I don't want to fix on the number that the Reserve Bank has put in. If probably that number is right, or it could be better. Given the recovery, I do not think it could be worse. The reason is that when the numbers were done, this was probably done in in May or so.
Yes, yes.
Before it was forecast.
That's right.
I would think that 2 months is a long period in this the course of this disease.
Okay.
I've had to revise what I'm learning.
Okay.
I'm not that I'm speaking about it, but what I'm learning virtually every 2 weeks. So in the last 4 weeks or 8 weeks, 6 weeks, things have improved. So this number should hold. It could be the worst case scenario. When we should look out for a better number.
No, you are the original retail banker, actually. I mean, the way you steered ICICI from a development financial institution into a lot of retail lending. And that's why I wanted your view. This is the first really painful retail cycle we are seeing in terms of salaried jobs. So you don't think it could be that painful?
Yeah, it should not be. And again, the leeway that the Reserve Bank has given is enormous.
Okay.
I think within this, a banker should be able to meet most of his challenges and most of the challenges of his clients.
Okay. Well, since I spoke about development finance, let me just get that one comment from you. The government, we understand, is contemplating setting up another development finance institution because once again there is a problem of finding money for infrastructure. You have been there, done that. You have seen all the experiments in India from IDBI, ICICI, IFCI, IIFCL, IDFC. I mean, the entire range you have seen, including PFC and NABARD and NHB as well. What would your advice be? Another DFI is needed for infrastructure financing?
I'll capture it in 2 sentences or 3 sentences. If you look at the history of DFIs in the 50s, they were set up because there was absolutely no financing available for industry. In the 90s, we had to course correct because there was absolutely no funding available for a DFI. So they should turn. Now, why was there no funding available? Because till then, we were able to issue government guaranteed bonds in the market, which was giving us the funding base, as it were.
Yes.
All 3 of these things were there. In the 90s, that was withdrawn. So for force, we had to then convert ourselves to a new structure where you could get access to money.
Yeah.
Therein lies your answer. I think clearly, yes, there is a need for long-term lending type of institutions, or the market itself is able to provide long-dated instruments to these companies, whether new or existing. The problem is, where will this sort of a structure get access to a long-term funding, the institution? If that can be resolved, then I think it is workable. So if you take the case of the BRICS Bank or the New Development Bank, we were clear that if we got a high enough rating, we could go out into the market and get the money given a strong capital base.
Yes.
So let's assume that this new institution has a strong capital base. I think what we need to make sure that its access to funding is well understood and well defined, so that it can continue to do it. It can perform the role that you are you want it to perform.
It is my expectation, my sense that the government will pick your brains on this, because I understand that some plans are afoot to encourage infrastructure financing. But thank you very much for all the contribution, all the extra light that you have shed on the Kamath Committee recommendations. It is important that KV Kamath thinks that not too much will go bad, and that he sees a lot of recovery. He's gone through the numbers, with great detail, and therefore one hopes that at the end of the implementation of these resolution plans under the Kamath recommendations, the corporate sector will come out looking much better. We have to take a break on that note. There's lots more lined up for you.